Welcome back. Let's now turn our attention to the third big story that we are tracking tonight. It seems inflationary pressure continuing to plague the common man. On one hand, we have seen both the wholesale and retail inflation rates coming down marginally, easing off. But on the other hand, rising prices in certain essential items are continuing to hurt. In the latest, it is milk prices which have seen a spike of about 2 rupees per litre. Both Amul and Mother Dairy have announced the increased prices, citing higher cost of production as well as manufacturing.
Food inflation is definitely hitting the common man, and right now we are at a dairy store. The news is that Amul and Mother Dairy, the biggest milk suppliers and milk distributors in India, are increasing the prices henceforth from 17th August. That is, from tomorrow onwards, 1 litre of milk, either from Amul or from Mother Dairy, will cost you 2 rupees more. And this is the second hike within 6 months that both these companies have taken. Before this, they had taken an increase of rupees 2 per litre, effective from 1st March 2022. Amul has said in its statement that because of the rising operational costs and overall costs, the feed prices that have increased for the cattle, they had to take this kind of an increase. They have said that they have only taken 4% rise in their MRP prices. Otherwise, which is very low, which is lower compared to the average food inflation that they have seen. They have said that overall feeding cost has also increased 20%, and which has led them to take these kind of price increases, be it Amul Taaza, Amul Shakti or Amul Gold. All these, the packets that you see right now being sold at 30 rupees per 500 ml packet will now be sold for 31 rupees for Amul Gold, and the same has been followed by Mother Dairy also.
So let's get in a little more perspective on the inflation situation in our country at this point in time. Dr. Santosh Mehrotra, senior economist, is joining us here on the broadcast. Thank you very much, Professor Mehrotra, for joining us. Your own view, because yes, we have seen inflation easing off slightly, whether it is retail and wholesale. But nonetheless, it seems that inflationary pressures on the common man continuing with respect to other items, essentials, that pressure doesn't seem to be going away.
You're absolutely right, and I've been predicting that this is exactly what's going to happen, and the reason for that is very straightforward. You see, from early last year, wholesale price indices have been running at, over 12%. Very recently, WPI had gone to 15% plus, and now it has just slightly eased off to 13% plus. The point is, compared to that, as you are showing on the screen, retail inflation is roughly half that level. Now, how is this to be explained that WPI is double the level of the retail? Well, it means that producers were absorbing the costs. The input costs had been increasing for a variety of reasons. One of them, of course, is the distribution costs, which have gone up for every item on account of petrol and diesel taxes imposed by the central government mainly. And this was bound to feed in to retail inflation. So, we shouldn't be feeling very happy that retail inflation has somewhat eased. The fact of the matter is that not just milk, other products will be affected, including agricultural produce, because we know that the input costs for farmers have been increasing, and input costs for everyone has been increasing, as is inevitable when the WPI is been running much higher than retail. So there is a limit beyond which producers will absorb the costs. They are now beginning to pass on the costs. So you're seeing this with milk. You will see this with other produce and other products, and I've been predicting this for weeks now. Ever since we've been talking about inflation. But I mean, the government doesn't care, obviously.
Right. So in that case, Professor Mehrotra, what is going to be the impact, or is there going to be that sufficient impact coming in when we look at the RBI's rate hike, aggressive rate hike mechanism that it is going in for? How do you see the effect of that?
It might have an impact on the RBI's rates, but the bottom line is the following: that food inflation is not affected by interest rates.
Yes.
Food accounts for about 45 to 50% of the total weight in the retail prices, in the consumer price index. Now, if that's the case, most of these transactions happen in cash for food, and all the distribution also in most of those transactions happen in cash, and interest rates don't come into the picture. Just as interest rates don't come into the picture in respect of fuel. Fuel prices are impacted, A, by government taxes, and B, by international prices. So, for over half of our CPI or consumer price index or inflation rate, the RBI has precious little role to play. The RBI's interest rate impacts what is called core inflation, which is the remaining 45% of the weight of the products which are supposedly core: cement, steels, etc., etc. Anyway.
Right. So what is your own take in terms of how we are going to see inflation move in India going forward? Because the RBI has said that by end of this year, we're going to see a significant drop in inflation. But what's your own perspective?
On the fuel side, the government is hell-bent on keeping taxes high, and it's not reducing it, despite the fact that inflation is running at the rate at which it is. And WPI is running at the rate at which is. So, the government is not willing to see sense. This is problem number one. Problem number two, as far as fuel-based inflation is concerned, we don't know what the oil prices are going to look like, because the Ukraine war doesn't seem to be going away. Russia has dug its heels, and Ukraine has dug its heels in as well. So this war is not going away, which is keeping prices high, because economic sanctions are going to survive. And, there is, please try and understand, a deeper than the various factors that have been mentioned, that the government put in place post 2020 an Atmanirbhar package in which there was massive injection of liquidity into the banking system and into markets. And because of this massive injection of liquidity, which was way above what other emerging market economies put in place in response to the COVID-induced economic crisis, the liquidity is still very much there, and that is also fueling the inflation. There's a wrong policy advice, whoever was giving it to the RBI or within the RBI or the government, and we are still going to pay the price for this. That's what's happening.
In that case, Professor Mehrotra, with respect to demand, because if, like you're saying, we're going to see what we've seen happen with milk today is going to possibly happen with other commodities, other essentials going forward. You have that happening on one hand, the prices increasing. On the other hand, RBI increasing rates. So obviously, people are not going to borrow as much. What happens to demand then?
Well, domestic demand at least is unlikely to rise, for the obvious reason that unemployment rates remain high, the employment rates still continue to fall, and the government is not willing to reduce taxes. Yes, when the elections are around the corner in Himachal Pradesh and Gujarat, suddenly the taxes on petrol and diesel will be reduced, but then they'll be jacked up again. So, it's not as though these are things which can't be controlled. They can be controlled, but provided the government shows the willingness to do so.
All right, we leave it there. Thank you very much, Professor Mehrotra, for joining us with your perspective on the inflation scenario in the country.